You tap your card for a £4 coffee. Beep, approved. It feels like £4 just jumped from your bank to the cafe. It didn't. A message raced through several companies, asked your bank for permission, then returned. The money itself could move later. So what did that beep really mean? Let's follow it. And where exactly did the money go? First, the card is not a tiny wallet. Shake it and no coins fall out. Instead, it provides information that lets a payment request begin. An identifier, the £4 amount, the merchant, the time, and security information. Those details are stamped onto one packet. The card carried information, not cash. The terminal also supplies the transaction's local context, and that packet now needs somewhere to go. The request does not jump directly to your bank. It first passes through the cafe's payment setup. A processor, payment facilitator, or acquiring provider may be involved. For now, call it the merchant's payment provider. It checks which merchant sent the request, attaches a return route, and dispatches it onwards. In card industry language, the provider connecting the merchant side is often called the acquirer. It is the cafe's doorway into the wider card system. Next comes the card network. Think of it as a huge switching system connecting the merchant side to the bank or company that issued your card. The network reads the packet's routing information and sends it towards the right issuer. It does not need to know your coffee order. Its immediate job is to move the request and the reply between the correct participants, quickly and reliably. Thousands of other requests can use the same switching world at once. The orange packet can cross this network in the time it takes the terminal to beep. Now the issuer decides. Is the card usable? Is enough money or credit available? Does the purchase look suspicious? Real checks are more complex, but those three questions give us the basic model. The issuer can approve or decline. Approval means it agrees to honor this request under the relevant rules. The verdict then races back through the network towards the cafe. A decline would send a different reply and stop this purchase here. The terminal beeps. The cafe unfreezes. We have an approval, but we do not necessarily have final settlement into the cafe's account. Authorization was the fast conversation. May this payment proceed? The issuer said yes. The transaction can now appear pending, and the merchant can hand over the coffee. But the slower accounting journey still has work to do. Approved and finally paid are not the same state. Afterwards, payment records are collected and reconciled. This is clearing. Transactions are grouped, checked, and used to calculate what participating firms owe one another. If Bank A owes Bank B, while Bank B also owes Bank A, the opposing flows can be reduced to a smaller net obligation. Thousands of instructions do not require thousands of separate piles of money to move. Clearing works out who owes what. Netting makes the later balance movement far smaller and more efficient. Settlement is the consequential step. Balances between financial participants are actually adjusted according to the system's arrangements. In the UK, major card systems can settle deferred net positions through accounts in the Bank of England's real-time gross settlement infrastructure. The exact timing and path vary, but the principle is simple. The compressed obligation becomes a real balance movement, which supports the payout route towards the merchant. One heavy movement can settle a vast batch of earlier instructions. But the cafe may not receive the whole £4. Accepting cards costs the merchant money. The merchant service charge can include interchange, scheme, and processing fees, plus the acquiring provider's own costs and margin. In a typical four-party payment, the merchant's acquirer pays interchange to the card issuer. Where UK domestic consumer card caps apply, debit interchange is currently capped at 0.2% and credit at 0.3%. That is only one component, not the cafe's total fee. Pricing and arrangements vary. Debit and credit can use the same payment rails. With debit, the £4 is linked to your account balance. With credit, the issuer pays first and you owe it later, possibly with interest. Same tap, different financing. Refunds do not rewind the payment. They create a new instruction. Disputes take another, conditional route, a story for another episode. Now rebuild it. Card to merchant provider network issuer. The approval message runs out and back. Later, clearing calculates obligations, settlement adjusts balances, fees are accounted for, and the merchant receives its payout. The beep meant your issuer agreed. The payment had work to do. Simple tap, hidden network, cold coffee.